We all set? Okay. Hi there. We'd like to get started. Thanks for joining us today. Thanks for coming to listen to some accountants talk about succession planning, the beer necessities. That's the name of our presentation, and that's about the quality of the jokes you're going to get during this presentation. We are accountants after all. So first of all, a little bit about us. We're from an accounting firm called Crowe MacKay. We're I
think they're working on the back.
I am pretty quiet. Is that better? Okay. So we're from an accounting firm called Crowe MacKay. We're a mid-sized firm based in West and Northern Canada. So we've got 8 offices, about 400 staff and professionals, and about 60 partners. Devon and I are both partners in the Vancouver office of Crowe MacKay. We're, I think, the 10th largest accounting firm in Canada now, and we're part of a large global affiliate called Crowe Global, which is also the 10th largest affiliation in the world. We're a full service firm, so you can see a list of different services we provide, including audit, tax, insolvency, valuations, and we'll touch on a few of these different services today. So my name is Daniel. I've been doing this for about 25 years. I'm a chartered professional accountant, but also a chartered business evaluator. So the CBV designation is a specialty designation that typically you perform after doing a CPA. And it basically enables you to specialize in valuing businesses and assets of different kinds, typically privately held assets. I have a varied practice. I do lots of litigation work. So that's what you call kind of expert witness testimony. So often I'll be working on things like shareholder disputes, and part of your job is to opine on the value of a business and then go to court and be cross-examined to support that value. As you can see, I also do lots of other things. So public company work along with M&A work, mergers and acquisitions. So, things like pricing businesses for purposes of selling them, due diligence on behalf of purchasers, as well as assisting in negotiating transactions on behalf of the buyer or the seller. And I have a bunch of experience in this industry. So valuing and helping transact breweries, pubs, nightclubs, and liquor licenses.
So I'm Devon. I've been doing this for 14 years, I think, maybe 15 years. I'm one of our tax partners there. So I deal a lot with private corporations, private enterprise, as well as cross-border taxation. So anything that's coming across that border, if you're expanding or coming into Canada, we deal with that. So I'm one of, I think, 4 partners in our Vancouver office that focuses on a lot of our domestic private enterprise.
So the purpose of this talk today is to identify different methods or ways of passing on your business. So divesting your business. You still hear me okay? Divesting the business. So we're going to consider key valuation, accounting, tax, and other implications involved in each of these divestiture strategies. And the main methods of divesting your business I've put up there. It's not exhaustive, but it's pretty much the key ways. So first of all, we're going to talk about sale of a business to an arm's length party. So a third party, an unrelated party. Merging your business into a similar size business, or doing a business combination. Selling your business to an employee or employees. The sale of your business to your children. And finally, we'll end on kind of a low note talking about liquidation of assets. So first of all, what's involved in the sale of your business to a third party? The schematic I have in the slide up above shows really the key parts of the divestiture process. And this is kind of an all singing, all dancing example of what you would do if you wanted to sell your business. But the first step, the key step, assuming you don't have any buyers, is to identify those buyers, identify all the different parties that might want to purchase your business. And obviously, the wider you cast your net, the more successful you're going to be in creating some kind of auction for your assets, which is typically what you want to do. You want to create some kind of competitive bidding process in order to maximize the value. In addition, you typically want to attract buyers to the table that are what we call industry buyers, or people that can obtain buyer-specific synergies. So for example, it might be people that have an ability to merge back offices with you, or it could be it could be companies where you have complementary product lines, right? They're typically willing to pay more for a business because they have those synergies available. And so long as there's more than one of them and you can get them to compete for your business, you can sometimes realize those synergies in the price that you ask. So once you've identified buyers, typically you'll send out what's called a teaser. And it's a short document with quite generic information about the business for sale. So at this stage, you typically wouldn't tell them the name of the business, and you won't give away too much information about the operations or financial condition of the business. All you're trying to do is solicit from them a non-disclosure agreement so that you know your information is protected throughout the process. And once you've done that, you'll typically send a further document to the smaller universe of buyers that are now interested. And it's called a confidential information memorandum or information memorandum, or IM. And it's a longer version of the teaser. Sometimes it will identify the name of the business that's being transacted, and it will give a little bit more financial and operational information. And really the idea of this stage is to give just enough information that the purchaser or potential purchasers can make a decision about what kind of price they want to pay and what are their terms. And so much the way realtors, when they're selling a house, they'll typically look to create an auction ending on a particular day when they accept bids. So it is with this sales process. You'll typically solicit letters of intent, they're called, for a particular date and time. And when you get those letters of intent, you know what that will have is, here's the purchase price, here's the terms, we're going to pay some cash, we're going to have some debt, we're going to pay over this period of time, we're willing to put a deposit. It's got all the different terms that this buyer is willing to consider. And typically you'll lead them in that process, telling them what terms, you know, what kind of things you want to see in that letter of intent. So once you have the letters of intent, you know, the next idea is that next stage in the process is you qualify them and you see which are your kind of preferred ones. And typically you're trying to, you know, you might want to have more than one preferred buyer, but normally they will want there just to be one, right, before they go ahead into the next stage of the process, because all of this is costing them time and money in terms of professional fees and so on. So assuming that you know, you have a letter of intent and you have a preferred buyer, you'll next start part of the process called due diligence, which I'm sure everyone's heard of. And it's really a stage where the potential buyer is able to look at a deeper level of accounting and operational and financial information. Basically, what they're doing is kicking the tires on your business to see, you know, are there hidden skeletons in the closet? What are the commercial strengths and weaknesses of the business? You know, what are the things that they should be thinking about when they finalize or are finalizing their bid? At the same time as that's happening, you're typically seeing lawyers negotiating a purchase and sale agreement, which is meant to enshrine the terms, the principles outlined in that letter of intent that you accepted. So this is still a part of the transaction where there'll be back and forth between lawyers and negotiation about those terms, because there's still plenty of scope to disagree. It's just principles in the letter of intent. And then finally, there'll be a closing at the end. And typically that involves a balance sheet audit for different reasons, mainly to do with wanting to know what the actual working capital of the business is at the transaction date, because there's usually a true up with the amount of working capital that you've agreed to leave in the business. So I guess the two main things I want you to get out of this slide is, of course, here's how the process works, but it's really key that if you're planning to sell your business, you try to control and disseminate information, according to your own plan. So very often I work with buyers sellers. And what's happened is they've been approached by somebody about buying their company, and they've simply given them a bunch of financial information, right? And it's confidential business information. So I've seen people give this information to competitors. It kind of beggars belief, but it happens. That's the next slide. Yeah. Here, yeah, it's a good question. A logical question. So this slide is really about who you use to make this process happen. And it's really driven by one main consideration, which is the one you identified. Do you have buyers? So if you do not have buyers, there's really two different parties that will be able to attract them to the table for you. One is the M&A advisor, and I'll talk a little bit more about that in a second, and what I call a business broker. And the difference between them is an M&A advisor, it would be someone that works at an accounting firm like mine, or separately in a boutique firm, right, that just specializes in doing mergers and acquisitions. So it's a professional in that kind of context that their specialty is making a market for your business. So they have a network of contacts that they can reach out to and provide those teasers to, where they have databases of information that facilitate them doing that, making an active market for your business. Sure. Yeah, so in assessing a business broker, one thing I would look to do is get a warm referral to that business broker. If you have an accountant or a professional that you work with, they very often know about the different qualities of a business broker. What's that? As I say, what I would do is reach out to your accountant or someone that you trust, maybe your legal counsel. Essentially what you need is someone to assess the abilities of that broker. So you need somebody that you trust, right, to be able to do that. So that would be my recommendation. And your question is a good question, right? Because the difference between a business broker and an M&A advisor is probably, it's manyfold, but at least one of the differences is quality. So the M&A advisor is typically, they're running a full process. They're taking an active role in marketing your business. The business broker, far more often what they're doing is a relatively light amount of pricing of the business. They do a little bit of pricing and get some kind of suggested price. So very often they state that, which I think is necessarily a bad idea, right? If you're trying to sell a business, you want other people to make offers and to give you prices rather than the other way around. But it's the nature of the thing. So very often they're putting your business with some details, something like a teaser on a website available to the public. So it's a more passive form of marketing your business. Now, some business brokers are a little bit more active and aggressive in marketing your business. And that's why your question is important, right? So you need to find a way to find the right ones. And, my suggestion is you usually, especially in a, small town like Vancouver, find someone you trust that will tell you that, or call me. You can. So they have this in common, business brokers and M&A advisors. Their fee structures are often similar. They're both going to want something called a work fee, which is basically they want to be paid for doing the preliminary work of pricing your business, doing a teaser, doing an IM, and so on. So they'll usually charge an hourly rate or a fixed amount to deal with the business. The main way they make their money, though, is through what's called a success fee, which is contingent upon them selling your business. And it's typically a percentage of the overall price that you realize, determined in different ways, of course, depending on the broker or the M&A advisor. And of course, the question is always, which is better for your business? I've kind of already tipped my hat. I mean, I think the full process is going to be better for your business every time. It's going to the M&A advisor. The problem is that they can be picky about the clients they take on. They need to be a certain size before it can justify the amount of work that they've got to put into preparing the materials to do a full process. So that's all if buyers have been identified. If they haven't been identified, if buyers have been identified, you can run something like less of a full process. So, somebody might come to you and say they want to buy your business. Maybe you have 2 or 3 people that you want to reach out to. That's a more limited process. You probably don't need a broker or an M&A advisor. There, your boutique or a firm like mine is well suited to that kind of process. What we do is we help you with some initial pricing. We'll help you negotiate appropriate terms around a letter of intent, purchase and sale agreement. We'll help you run a due diligence process. So all the main things that you have to do in getting your business sold, but without that first step of identifying the buyer, which is actually a fairly big deal in any M&A process. So I just got one last comment on this, sale to a third party, which is the kind of DIY thing. If somebody comes to you and they have an offer, I have seen this happen where owners will just vend their business themselves. It's not a great idea unless it's something that you do a lot of. It's not the kind of thing you want to figure out the first and only time you're going to do it. And I have seen this happen. It doesn't typically end well. It does range quite a bit. And usually it's structured like it's a laddered fee. So what they'll try to do is give you a specific price. And if they hit that price, they get, let's say 5%, right? And for every little bit more, it's laddered down, they get a little bit less. But there's not a standard.
So in selling a business, there's various types of ways you can actually do it. There's 2 main ones that we typically see is a share sale and an asset sale. Now you can see that there is a third one up there called a hybrid, and that's kind of a combination of the two where you do a little bit of an asset and a little bit of a share. Those are really limited in your ability to use them, and the tax legislation is really pushing to prevent you from using it. So we're not going to get into those, but just know that there are kind of 3 main ways of doing it. So the first one that we typically see is the share sale. And this is the preferred method for sellers because it's the simplest way. You're selling at the shareholder level. It's all gone. You get to walk away. Easy done. There's no disruption to the operations itself. You're not pulling and dealing with transfer of titles and various things, right? It's one and done. The other benefit of this is that any value that is accumulated in your business gets realized as a capital gain. So capital gains are preferred in terms of income and income tax because they're included in your income at 50%. So instead of, say, dividend income or employment income or salaries, which is 100%. So we really like capital gains. And as of right now, they're still at that 50%. There's always talks of it going up. So the other thing that is really beneficial of this type of sale is that you potentially can actually shelter some of that capital gain with your lifetime capital gains exemption. So every Canadian taxpayer has a lifetime capital gains exemption. And I think as of 2023, it's 971,000 and change. So if you sell what we call qualified small business shares, you get to potentially shelter upwards of 900 or almost a million in capital gains. So it's really beneficial to actually go that route. Yeah. No. So lifetime capital gains only applies to what we call qualified small business deduction or qualified small business corporate shares, as well as there's farming and fishing shares. So, and there's very specific criteria in terms of what qualifies there. We're not going to go into the technical because I don't want your eyes glazing over, more than they already are. But essentially, to qualify for that, there's a 24-month period that you have to look at, and you have to have a certain amount of percentage of your assets in your company active in active business in Canada. So that's kind of the rough and tumble of what a QSBC is. So part of that and part of our planning is trying to get you into that. So you might be a small business or a privately owned corporation, but maybe you have a bunch of redundant assets or passive assets that you've accumulated over years. Well, you may not hit that QSBC and you forego that lifetime capital gains exemption. So what we do is we call a purification strategy. So there we're trying to basically funnel out all the excess assets that are redundant or passive that kind of go against that. So oftentimes that's, paying out salaries or dividends to shareholders to kind of bring excess cash down, selling passive assets out. The other thing is paying off shareholder loans and other liabilities, because that calculation doesn't look at a net basis. So we want to, pay all those liabilities down, because that can bring down your assets without having any tax implications. So the other thing that we look at, and again, it's with that lifetime capital gains exemption, is actually multiplying that. As you call, everyone has it as a Canadian taxpayer. So if you have a bunch of family members, you have the potential of doubling up or multiplying it. So it can add up if you have a lot of people, big family. So the key thing that we often do is putting in a family trust where all those family members are beneficiaries, and we have shares held by that family trust. So the family trust can't actually use the lifetime capital gains exemption, but what we can do is funnel those gains out to each beneficiary to capture that. So the key thing, key takeaway here is you want to, if you're thinking about selling your business, you want to do it as far ahead as possible, because we want to be looking at that purification strategy as well as setting up that family trust. If you have a sale tomorrow, we can't really do anything because we don't have that time to actually implement any of these strategies. So the other one that we'll talk about, and I'll just talk about really quickly, is the asset sale. So this is kind of preferred for a purchaser because they get to come in and cherry pick what they want from your assets. They don't have to worry about any of your liabilities, all the headache of the stuff that they don't want. They come in, grab it. And the benefit of this is that they also get a bump up in the cost base of those assets that they purchase. So that can potentially translate into savings of tax later on. Now, this is not the greatest for sellers because, right, people have come and cherry picked everything out, but you're still left with this corporation with the other assets, all the liabilities, and now you have to deal with it. With this, you don't get the lifetime capital gains exemption. This is not a capital gain because it's all happening within the corporation. So you have flowing out of income, possibly as dividends. So this isn't the ideal for a seller. So often we see, sellers and buyers kind of at odds, and you might have two offers from the same purchaser where they will give you one value for a share sale and one value for an asset sale. So there's a capital gain potentially, but it's inside the corporation. So the corporation selling, it's the corporation that's selling it. So it may realize, if say you have some capital at land, for example, and you sell it within the corporation, that triggers a capital gain inside. The corporation pays the tax, realizes that all, but now it's still inside that corporation. You need to get that money out to you as a shareholder. So now you're having to flow it up, and that's usually a dividend. So it's not as effective for tax purposes.
So the next kind of category of divestiture of a business that we've considered here is really one where you likely aren't divesting it in some senses because it's a merger or a combination with another business. So, you know, in my mind, what I'm thinking of is two businesses that come together. They're 50-50, 60-40, maybe 70-30. But one, it's not a straight acquisition of another business. And this is something that this industry has seen a lot of in the last number of years, and it's probably going to see more of it. And it's really to do with the nature of the industry and the dynamics. So the challenge that so many are facing is that it's a fractured market. It's something like 90% of the brewers in terms of numbers are making 10% of the beer. So there's a lot of different brewers out there, and it's a highly competitive market. Of course, it's a fairly high fixed cost business, typically. So those are all circumstances in which, it's logical to look for economies of scale, to look to combine with other people, make strategic alliances, or these kind of formal alliances where you merge your business. And it's really down to, a word we talked about a few slides ago, synergies between people in the industry. So, if you combine, you can get these economies of scale by eliminating back office jobs, for example. Do you need two financial controllers or two CFOs? You probably don't. Do you need two different plants for brewing, or can you, kind of up your capacity? So use like 80% of one plant, which is obviously more efficient. Do you have complementary distribution channels? So you're distributing somewhere where they're not, and so on, right? These are all reasons that if you get together, you're going to be stronger together than apart. So, what are the factors you think about before you go into this kind of consolidation and combination? It's qualitative and quantitative, and the qualitative factors are actually really important. So, the main thing I'm thinking of here is culture. So there's actually quite a lot of evidence that most mergers or even business combinations fail, not because of financial concerns, but because of problems with culture. So it's very hard, especially if two entities are similar size, to get the cultures right, to get them to fit well together. And it generally can lead to problems. I know from experience, I've been in two mergers of accounting firms, and if the cultures aren't very, very similar, it can mean one of those firms, basically the people just walk out the door. In terms of quantitative factors, the two main things I think about are those synergistic expectations. So, especially entrepreneurs, there's, a tendency to be optimistic about what's going to happen. And it's an example of where you just need to be really hard-headed about what the synergies are and whether they're achievable. And, as someone who values businesses a lot, I find it very difficult, even with excellent access to management, to quantify what their synergies are going to be. So, if you don't do that properly, the combination isn't going to work the way you think it is, and it's not going to be worthwhile in the way you think it is. The other, and this is probably even more important, the other thing to consider is the relative pricing of the businesses. So I know from being involved in consolidation in this industry that that's something that can go wrong in a hurry. So you can agree about synergies and figure all that out, and you can have very similar cultures actually, and synergistic cultures too. But if you don't agree at the outset about the relative values of the two businesses, you're not going to get anywhere, right? And so you want to determine that first. It's self-serving for me as an evaluator to say this, but you need evaluation. Because what happens is typically someone will do something on the back of an envelope. The shareholders of one or the other company will get suspicious about the relative merits of that back of the envelope calculation. They bring someone like me in, and it's completely wrong what's been calculated. The valuation is not 50-50 or 60-40, it's like 90-10. right? And a bunch of time and energy has been wasted in the process. So I would always suggest getting the relative values fixed early on, and typically by a party credible to both, right? So a jointly retained person. My preference would always be evaluator over, say, one of the company's accountants.
So yeah, when you have a business merger or acquisition, there's a lot of things to consider here. I mean, I'm a tax guy, so I like to think tax is most important, but there's a lot. This is a holistic approach that you need to be approaching these acquisitions or mergers with. Some of the key areas are the operational considerations, the tax considerations, legal and financial. Now, Daniel kind of talked and touched on the operational, so I won't go into that, but we'll kind of take a quick look at the other three. So in terms of tax considerations, one of the big things is, are there any unknown potential tax liabilities with these target operations? Are they filing? Have they paid their taxes? Are they being audited? You know, that's a big thing that you want to be looking at and digging into, because you don't want this minefield, popping up when you all of a sudden are together. The other thing, are there tax loss pools in the other operations? So there are tax carry forward pools in corporations that potentially can be used. They're very limited in how you can use them, especially in an acquisition situation. So you want to be looking at, is there a way to effectively structure this acquisition so that you can utilize that? And then ultimately, how is the business going to be structured, or the group going to be structured? So like Daniel said, there's a lot of ways that this can be structured. Two separate companies. Is it a parent sub? Are they, are they going to merge, amalgamate? There's a ton that can go into this. So you want to be looking at what's most tax efficient as well as what's good for the operations. In terms of legal considerations, I mean, one of the big things that we see is non-compete clauses and whether they're going to be in there for exiting stakeholders. If you're coming in and taking majority, or someone's walking out, are they going to be able to just walk out, set up shop, and start competing against you? So you want to be thinking about that. The other things, existing lawsuits or other litigation or legal proceedings. Again, are you walking into a ticking time bomb? And then are there any other risks to consider, maybe that are not touched there? In terms of the financial considerations, is how are you going to fund this acquisition or merger? And what level? Is it at the shareholder level? Is it within the corporation? Is there a mismatch of where it's going to be acquired and where the funds are? Do you have to do some planning, in order to get that done? Are there any liquidity concerns? So if you're buying out, if one company's buying out or merging with another, is that going to actually cause cash flow issues for the operations? You want to be thinking about that. Are there bank covenants that you have to think of? So there's a lot of bank covenants about acquisitions and use of funds, and even debt to equity ratio. So you might fall foul of that accidentally because you go ahead and make an acquisition. So you want to be conscious in contacting all your trusted professionals when you're going into this. And then lastly, again, are there any off-balance sheet liabilities? Is there something that you don't know about or is not showing up on those financial statements that's going to bite you in the butt afterwards once you acquire it? Great question. Next slide. So the big takeaways here is, just think that mergers and acquisitions are quite complex, and it's a holistic approach that you have to take. The sooner you can get your trusted advisors in, the better. And I'm talking lawyers, accountants, valuators, and your bankers, because they all have a different viewpoint on this same transaction. So you don't want one doing everything because you might miss it. But lastly, doing your due diligence. That's where you're going to be looking. So if you're looking to acquire, we go through a due diligence process, financial due diligence, tax due diligence, where, say, your accountant, me, will come in, get access, and look through and put a report together going, hey, these are potential concerns. So at least you know about them and you can plan for them.
So our our third category of sale is sale to employees. And, you know, as I say on the slide, it's obviously a logical buyer of the business, and there's some advantages and disadvantages to selling to employees. You know, a clear advantage is that they're in the business already. They're already potentially helping you run the asset, and they know it well. That can be a disadvantage too, in the sense that they often know, you know, where the skeletons are in the business. They know what the risk is. That might make them a little bit better at assessing, you know, assessing that risk, and frankly, reducing price. You know, the other, I guess, big disadvantage of selling to employees is something that Devon just touched on a minute ago, which is access to financing. Like, how are you going to pay for this? So an employee tends not to be a wealthy individual. That's why they're employees. They don't have a lot of access to capital. And so you have to have kind of inventive ways of bringing them into the business. And we've jotted some of those down. So things like vendor takebacks. A vendor takeback is essentially, you know, you loaning them money to buy your business. And the obvious concern there is, you know, how much money you're loaning them, what's your security, you know, to ensure payment, and what are the terms of the note that you're giving them, and are you being appropriately rewarded for the risk that you're taking on in funding, you know, kind of financing their acquisition, in playing the bank. Slightly preferable is something that I think maybe Devon's going to touch on more in a minute, which is something called a share freeze. And what that means is that it's a technical thing, but basically you value the business at the acquisition date, and you do an exchange of shares. So the seller of the business gives up their common shares for preferred shares in the business, and those are redeemable and retractable at a set rate, the rate that you agree to value the business at. And you issue new shares, common shares, to the buyer of the business. So they get all the growth in the business, right? Because your preferred shares stay the same value. And what that does, obviously, is usually you have votes with those prefs. So you still have control over your business. You're, in other words, in a slightly better position if something goes wrong in the business, to be able to take control and, you know, see the ship gets back on track. You know, some other thoughts about financing. I've got mezzanine financing down there. Mezzanine financing is basically cash flow financing. So where there's no more assets to finance against, like receivables or capital assets. Mezzanine financing is just financing that's secured on the cash flows of the business. So the business, in other words, has to be cash flowing in order for this to be available, this kind of finance. And it's typically more expensive in terms of interest than typical debt. It sits somewhere in terms of expense between debt, which is, you know, quite low because it's secured in terms of interest rate, and equity, where equity holders are going to demand quite a high return for the risk they're taking because they sit so much further down in the balance sheet. The final, you know, issue, and it's related to the fact that they can't pay a lot for the business, is that you're probably not going to get the highest price selling to an employee, right? They're probably not going to have this access to financing. They're not going to be an industry buyer. Those synergies that we've talked about a couple of times are not going to be available to them. So just one last comment on employees and shares. It's very, very common, especially in this industry, actually, to incentivize employees by providing like small amounts of shares, equity in the business of, you know, 5-10% or whatever. And it's a good idea to try and align your interests and your employees' interests. You know, my word of caution is, you know, as I mentioned at the outset of this presentation, I do lots of litigation work for valuations, and very often it's shareholder disputes that arise in this kind of circumstance. Your friends, you know, your buddies right now, you give some shares up, and it's, you know, they have a legal position in the equity in your business. It's not easy to get them out of that structure if something goes wrong.
So yeah, as Daniel mentioned, the one big thing here for terms of tax planning and strategies is the crystallization. So the freeze of that company. And essentially what you're doing, say the company's worth $1 million and you have, your common growth shares that are participating. What we do is take that and then freeze them and exchange them for pref shares that are fixed value of $1 million. So now the $1 million is attached of the value of the company is attached to those fixed preferred shares. Now new shareholders can come in and subscribe for new shares, growth shares, for nominal value. So it is really quite an effective way if your financing is not quite there. The one thing you want to, and in terms of benefits is that this is, again, because this is a disposition of shares, there is the potential of utilizing your lifetime capital gains exemption. So if you don't have a third party that you're selling to, this might be an option. So it's another thing to look into. The one thing you have to really consider here, though, is there could be a conflict of priorities between you as an exiting shareholder with pref shares and the new up and coming growth, right? People want to reinvest it and grow the business, and they don't want to send the money out. So there might be conflictions there. And a lot of times our pref shares don't have votes. And so, yeah, you may have $1 million of pref shares, but you have no ability to protect it. So a lot of times we want to factor that in. A lot of times in these freezes, we actually give back some voting shares that aren't participating, just so that you maintain that control. Another thing that we like to see is a shareholder agreement. So those shareholder agreements really dictate how things go, and it kind of clears up any confusion and potential conflicts.
So our fourth category of divestiture is sale to children. And, I have the comment here, how relevant is this to this audience? I'm not sure. It's a younger industry. So typically we think about succession, passing on a business to children in the context of a mature industry, mature company. The typical way of doing it is the way that Devon just described, the Section 86 tax freeze, where the preference shares are issued to you and the new growth shares are issued to the children. I won't say a lot more about selling the business to your children, other than to bring up some qualitative concerns. The things that I've seen over the last 25 years that come up again and again and again when you see new generations being introduced into a business are questions around, should it ever have happened, right? So are the children actually wanting to be in the business, or is this just something that you want for them? Are they able, maybe they want to be your replacement, but are they actually capable of running a business now? Maybe it's just too soon, or maybe they're never going to be able to. It's not for everyone running a business. It's hard work, right? The other thing is family dynamics. So, you have 3 kids and you leave it to all 3 kids and they end up hating each other, right? Or you leave it to 1 kid and there's 2 other kids that do nothing. You leave it to 1 kid and you leave it to 3 kids and there's like 1 kid working in the business. The other 2 are basically getting a free ride. Or you leave it to all 3 and they hate each other. They can't get on. One of my first experiences in public practice was, I didn't have to do this, my boss did, but we had a family that owned a business and he had to go along and fire the daughter on the father's behalf because she couldn't get along with any of her siblings anymore, right? And the father wouldn't do it. That's, the nightmare scenario when it comes to this kind of thing. So, again, you're not going to get the best price passing it on to your kids. And just like another little example of something I've seen quite recently, actually, not in this industry, but, a family, I'm going to say 4 or 5 years ago, came to me with a business and they wanted me to value the business and they wanted me to tell them how to improve the value in the business, which is what I talked about last year at this conference, how to improve the value dynamics in your business, right? And he went away and did that. They did not pass on the company at that time to the kids, but it was something they were interested in. It's why they were doing it. And then I guess last year they came back and now the kids were ready to buy the business. I think I valued it at $6 billion 5 years ago. And now it was worth 14 when I went and revalued it, which wasn't all because of what I told them to do. It was COVID and things like that helped a lot in this particular case. The kids still wanted to buy the business for $6 million. That's what they had in their mind. And, you know, I think in the end, they agreed to sell it for something like 12 million to the kids, but structured in a way so they're only ever going to pay 6 million, right? They're going to end up with some kind of structure where there's these preferred shares that just never get redeemed. And I look at that and I ask myself, would it not make more sense to sell the business for $14 million and then give some money to your kids, right? So that's this kind of taken to a logical extreme.
Yeah, and just to that point, there's many a times where I've walked into a business meeting as the tax professional and then turned into the family therapist. So we end up being the bad the bad guy in terms of delivering bad news. So we see it all the time. It's surprising, and it's not just families that are already at each other's throats. It can be the best cohesive family, but when it starts getting into money and people start getting really weird. And it's not about the funds, it's about what that represents. Dad loves you more because you get more of the business. So people get really irrational really quickly, and it just evolves. So it it can be a fun time. But on that note, intergenerational transfers, prior to 2021, it was actually kind of a detrimental transfer for tax purposes. The legislation didn't really allow for an effective transfer from one generation to the next. Essentially, again, not going to get into the fun rules. What happened was what would normally be characterized as a capital gain was converted and recharacterized to dividends. So you lose out on the 50% inclusion rate and the lifetime capital gains exemption. It was really bad, to the point where it made more sense to sell to a third party than to pass it on to your children. So people didn't like that. And then in 2021, a new bill was introduced that kind of attacked this discrepancy. So again, if you want to know all the nitty gritty, come see me. But essentially what it's done is that if you have a qualified small business corporation or a family or farming company, what you can do is you can transfer that interest into a corporation that's controlled by a child or grandchildren. And what it will is not recharacterize that transaction. It stays as a capital gain. Now, with that, there's a lot of hoops and criteria to jump through. And this legislation is really new and it keeps changing. So as of January 2024, it's changing. So if you are looking to do that, talk to your trusted advisor, because there might be some planning and things that you need to consider.
So this is our last category of sale, and it's as I said, it's kind of ending on a low note in a way, but it needs to be talked about. So liquidation of a business. This is where your business is no longer a going concern. You know, unfortunately, we are seeing this in the industry quite a bit lately. You know, you've got negative or even break-even cash flows. They're not sufficient cash flows though to support the investments and the tangible assets of the business, right? So there's no goodwill in the business. It's more a case of, you know, what can you realize for those assets? And there's really two different kinds of liquidation that you can undertake: an orderly or a forced. And the forced is more, you know, events have overtaken your business, and that's the last thing that you want to do. So if you find yourself in a circumstance where you're having difficulty trading or you're becoming insolvent, better to go and talk to someone at that point than to wait, because the forced liquidation, you know, necessarily you've got a fire sale of the assets and you're likely getting pennies on the dollar, right? Instead of if you take the orderly liquidation route, you know, the things can be sequenced and they can be timed in a way that benefits you. I've got down there bankruptcy or receivership. The key difference between the two is a receivership is the business still has some hope of going on. Typically what's happened is it's taken on too much debt. And it's in the interests of the debt holders to restructure that in order to get some of their money back. And they'll put a receiver in the business. And the receiver's job is to restructure that debt, pay off creditors, put the business on a firm foundation so it can continue trading after the receivership event. Whereas a bankruptcy is, frankly, you're winding up the company. You're just selling the assets and trying to close things down. And you know, the common theme in this presentation, we keep saying seek professional advice. And our firm certainly offers this advice. I'll skip forward a slide or two. These are our insolvency professionals, and this is how I know that there's a lot of work in this particular industry around this. Is they've seen it a bit.
Yeah, so typical accountants ending on a negative note here. But when you are dissolving a company, there are things to consider from a tax perspective. One thing, are you in a position to pay the taxes? Because CRA can actually go after you as a shareholder and a director for certain types of tax. So you don't necessarily have that protection. They'll come through and go after your personal assets. So just be aware of that. And you don't want to be leaving yourself up personally for some of these tax bills. The other thing, have you filed everything correctly? Have you filed it? If you're ceasing operations, your year end might change because you're stopping midway through the year. Your filing deadlines are changing. You may actually have to do forms to close out these accounts. So there's a lot to kind of get done there, and you have to think about. So again, talk to your accountant about that. The other thing, what are the tax implications for you? Maybe there is net assets that are being distributed up to you on that dissolution. Well, that could have tax implications for you personally. So it might be dividends, it might be capital gains. And how can we best put you in the best position? Maybe there are pools there that we can get you as tax-free capital gains, or tax-free dividends, or preferred dividends, as opposed to just straight up ineligible dividends. Now, in terms of legal steps, again, I'm not a lawyer, but there are actual formal proceedings to dissolve a company. So looking at that. The other thing that you have to be considering is, do you need to do anything? Is there any legal things? Do you have titles over assets that are maybe distributing out to you? Do you have to transfer the title over? Are there agreements that you have to, or people you have to notify? There's a lot of steps that you might have to be doing in order to do that. Notifying other shareholders if you have outside shareholders. So there's a lot to kind of, even in dissolution, there's a lot to think about. So talking to your accountant ahead of time is the best thing.
Okay, and I think that's all we've got. Is any questions? You've asked good questions throughout, so we appreciate it. Okay, great. Thank you.